Hello, clients and friends. This is Craig Lewelling from U.S. Investors International, and it is my pleasure to present our fourth quarter economic review. And I also want to give a little update on the tariffs that are now being imposed on Canada and Mexico, and the fact this morning, it's Monday, February 3rd, and this morning, Mexico anyway has come to terms with the U.S. and has agreed to, they and the U.S. have agreed to pause the tariffs for 30 days. So we'll talk a little bit about that. At our firm, as you know, we partner with clients and believe an educated client is our best client. And while we always try to best to help you with your finances, we believe that knowledge is power. And one of our missions is to share any knowledge with clients to help you make an informed decision. As you can see from the charts, the fourth quarter was a roller coaster of a ride for investors. Equities remained highly sensitive to the good news and bad news that kept us on our toes, including the lower interest rates, but the potential for the slowing down of monetary easing. Needless to say, the last quarter of 2024 was not a smooth ride by any means. Volatility remained prevalent for investors. The last month of the quarter, we actually saw the Dow coming down 2 to 3 percentage points between the Dow and the NASDAQ. So at the end of the year, for the quarter, people were down, but for the year we were up. Needless to say, the last quarter of 2024 was not a smooth ride by any means, and volatility was prevalent for investors. The S&P 500 ended up the quarter 1.9%, and Dow Jones average closed the quarter up 0.7%. While the fourth quarter was not as sensational as the previous quarters, the S&P 500 ended up the year 23%, and the Dow ended up the year 13%. Inflation remains to be stubborn. In November, the year-over-year consumer price index was 2.7%. The core CPI excluding food and energy, was 3.3% year-over-year. A major contributor to these sticky numbers was the shelter index, which saw a significant increase in the fourth quarter. The shelter index tracks the health of the residential real estate in the country, which has been very sticky given the supply has been very limited due to the interest rates. A few years ago, people were refinancing at major low interest rates. It's really hard to give those up when prices are still pretty high. To sell your house at a 2 to 3% interest rate on your mortgage and go to a 6.5, 7 is pretty tough with prices not moving much. While inflation is gradually moving towards the Fed's 2% target, the persistent nature of the inflation, certain proposed economic policies may lead the Federal Open Market Committee to slow its easing efforts in 2025. And we indeed, this last month, the Fed said they're going to pause, they're going to slow down. We still think we'll see these coming down, but it's going to be slower than they had originally anticipated in the last part of the year. After a 50 basis point reduction in September, the Federal Reserve cut interest rates 25 basis points twice in the fourth quarter of 2024, bringing the total to 3 cuts for the year. These are the first changes since 11 rate increases from March 2022 to July 2023. The decision to lower interest rates came in response to key indicators suggesting that economic activity continued to grow at a solid pace while unemployment rates remain low. Typically, equities respond positively to rate cuts. However, during the December meeting, Fed Chair Jerome Powell indicated there might be fewer rate cuts in 2025 than were anticipated entering in 2024. This cautious outlook led to a quick decline in equity markets. Again, that's what I was talking about at the end of the month. At the end of December, December was a rough month in equities. And the beginning of January was fairly rough. And then the mid-January or second week of January, things came back almost even. And then since then, we've been kind of sideways or down at this point. Interest rates and inflation play a crucial role in investors' financial planning, and therefore we will continue to monitor and change and stay informed about these key economic indicators. And this is true with tariffs. A little bit more on these tariffs. Tariffs end up costing goods to be more in the U.S., which they were talking about this morning's Wall Street. They were talking about how it could impact negatively to the GDC for the year. If that were to happen, if these tariffs do go into effect, at this point, we're not sure they will. given that there's been a pause on at least Mexico and Canada is to respond. They're negotiating right now. I suspect by this afternoon we'll see an agreement there as well. But if tariffs do take hold, they lower the GDC, which will put more heat on the Federal Reserve to lower interest rates. So this will be interesting to see how this plays out. As you may know, bonds have an inverse relationship with interest rates. One goes up, the other usually goes down. Yields are currently close to multi-decade highs. On December 31st, the 10-year note was 4.58%, which was somewhat higher than the end of the third quarter when it reached 3.81% at the start of the year when they were at 3.95%. The 20-year Treasury entered the fourth quarter at 4.86%, and the 30-year note closed at 4.78%. The outlook for bonds in 2025 is hazy. Should interest rates continue to fall, bonds should appreciate. However, should inflation start to increase in 2025, interest rates may stagnate or rise. Again, with these tariffs, it's just a big unknown how this is all going to play out. Bonds can be a part of a well-diversified portfolio because historically they have lower volatility than stocks. With today's rates, they can become more attractive to investors fearful of equity volatility. We typically consider using bonds for clients based on each client's unique situation. Bond market's a whole nother world. So if we're using bonds today, we have to be very careful what type of bonds we're using as we move forward in this environment. Globally, the economy faced ongoing uncertainty during the fourth quarter. That continues today in the first quarter, though not as much emphasis has been on that at this point, given it's been more on these tariffs. But global tensions remained high in the fourth quarter, particularly due to the continued Russia-Ukraine war and unrest in the Middle East. Additionally, a new president, as we know, was elected during the period, marking the end of a highly contentious campaign season. Initially, the markets reacted positively to the election results. However, we did not get that Santa Claus rally at the end of the year with December because markets moved up so quickly in November. They actually retreated in December a bit. That it's going to be policy change. Now we have a new administration. We know that for sure, given these tax cuts are going to expire at the end of the year. Something has got to happen or something will happen. So with anticipated changes in economic policy and tax law, there are several key items for us to monitor. It's important to remember that corporate earnings and the overall economy are the primary drivers of financial markets. We are dedicated to staying informed about any changes that may impact your personal situation. Although there's still a lot of uncertainty in the economy, we are still currently experiencing a bull market. This bull market began in June 2023 after the S&P 500 rose 20% from its low in October 2022. The past few years have been exceptional for the U.S. stock market. However, inflation is being set up as a public enemy number one for the economy in 2025, and there is a mixed set of outlooks from analysts. Many are optimistic about a continued market rally driven by ongoing AI growth and deregulation, as well as the potential for lower taxes. If interest rates keep coming down, this could fuel the stock market forward. However, some are concerned that the U.S. could experience a market correction. When the S&P index falls more than 10% from a recent high, it is said to have entered a correction territory. The term correction is used because historically, the market drop often corrects and returns equity prices to their longer-term trend. There have been 24 market corrections since November 1974. They historically happen on average about every 18 months. The S&P 500 did not experience correction in 2024. Analysts say that corrections are healthy and even necessary for bull markets. They help shake out some of the so-called froth in the stock market, where prices run up too dramatically and get ahead of themselves. Analysts also share their correction isn't necessarily something to dread. Most strategists are still predicting solid earnings growth for equities in 2025. With that backdrop, most analysts project that stocks will head higher, even if there are some bumps in the road. And given that after the first quarter here, we still feel that, but given all the uncertainty, again with tariffs, is the new administration going to get these policies through? Where's Congress on all this? So we think the market stays bumpy here until at least the first couple of quarters, until we see what happens here in terms of getting all these policies in place and how much of a fight it's going to be through Congress. So as a recap, here's some things to remember. 2024 was a robust year for equities and left investors with positive returns The U.S. economy has been strong and long-term investors were rewarded with significant returns. The Fed reduced the federal funds rate range 3 times in 2024, with 2 being in the fourth quarter. Inflation pressures are still being stubborn. 2025 brings a host of challenges which are creating uncertainty and market volatility. The key items will be keeping a close eye on, including proposed tax law changes, proposed tariffs, monetary policy changes, stubborn inflation rates, and geopolitical issues. Again, tariffs may not be all bad in the longer term here. If it forces interest rates to come down more, it could be another tool that forces rates down. Remember, lower rates are a haven for stocks, for equities, for your companies that we're investing in. So we want to be well prepared, maintaining the consistency of a well-devised, long-term focused plan, which has historically served investors well. We're here for you. If you want to discuss or have any questions or concerns you may have, please let us know. But again, any market's overdue for a correction. It's healthy. I wouldn't mind seeing it personally, and whatever that takes to make that happen, it brings good value back. And so we think this stays volatile for a bit, but this could longer term end up being pretty strong for equities. So again, hope you have a great week ahead. If you're in the Portland, Vancouver area, it's going to be a cold one. So if you have any questions, give us a holler on any of this. We're grateful for you, for the opportunity to accompany you on your financial journey. Our goal is to assist more people just like you. The highest compliment we can receive is a referral. Many of you, of our most satisfied clients, were introduced to us by existing clients just like you. If you know someone who could benefit from our services, please consider sharing this video or adding them to our mailing list. We just give them our monthly newsletters, our quarterly newsletters. If you enjoy those, pass those along. We invite them to our workshops, which we've got those in place now. Our next one's going to be March 25th. And that will be in Clackamas. We're going to talk about, we'll give a little brief overview of the economy and taxes if there's some changes to be had there. The main topic on that is going to be disaster preparedness. After all the fires down in California here recently, and then all the stuff that went on in North Carolina, we did this a couple of years ago, 3 years ago, so it'll be good to bring this back. We're going to have Clackamas County come and give us a presentation on that. That will be a great presentation. Everybody should be in attendance on that. Everybody should be prepared for just basic things. So, but we would be honored if you could provide us with your contact information of a referral so that we can add them to our distribution list. Again, they'll be able to receive our newsletters and invitations on these different presentations. The next one being disaster preparedness. We'll do a beneficiary workshop. We'll talk about estate planning, wills and trusts. And then in the fall, we'll do Social Security and Medicare again. And then we're looking at economic update in November, having one of our economists come out and talk to us on that. So once again, thank you for your trust in us. One of our main objectives is to keep our clients informed, and we appreciate you taking the time to watch this update. Again, please feel free to call if you have any questions. Have a great week.